Good afternoon, everybody. I'm John Carnegie from the Business New Zealand Energy Council. It's a pleasure this afternoon to invite Lisbeth Spaniard and Ros Warburton from Deloitte Australia. Welcome. We'll hear from them today about the work they've done on the future freight scenario study. Actually, before we formally hear from Ros and Lisbeth, I'd like to ask Nick Brown from the Ministry of Transport to come up and to provide some context for the study, and Nick will then introduce Lisbeth and Ros formally. Thank you very much.
Thank you very much, John, and good afternoon, everybody. So, first of all, just if I can just explain who I am. My name is Nick Brown, and I'm the General Manager for Aviation and Maritime at the Ministry of Transport, and we are the organisation that commissioned the Future Freight Scenario Study from Deloitte. We at the Ministry, our primary role is to provide advice to ministers. We're not an operational agency, we are a policy agency, and our primary role is to provide advice to ministers, but we also take quite seriously our role in taking a long-term look over the whole of the transport system over a long term to see if we can identify trends and issues that we think we need to be tackling. So it's really within that context that we commissioned this piece of work. Going back to 2012, of course, we had the Productivity Commission report into international freight transport. And that was quite an important piece of work for us because it helped to sort of flag where we might be looking in the future. Some of the key headlines from that study for us anyway, sea freight costs are 21% higher in New Zealand than they are in Australia. Productivity in the transport industry had flatlined after a strong growth in the 1990s. So clearly, if we're focused on New Zealand's productivity and performance economically in the world, we have to try to understand what's going on there and is there anything we can do to improve matters. Some of the things that the Productivity Commission said that needed to be done were regulatory changes, and we have looked, as you'll know, at the whole area of bringing international shipping within the Commerce Commission's remit, and that still hasn't finally got through the parliamentary process, but that was one of the key things that's been done. But also what we took from the study is that the government has a role in providing information about freight flows, about the freight system into the sector so that the sector can make better decisions using the information that we can collate and provide. So particularly with that in mind, there's actually three key pieces of work that we've done. The first was the Freight Information Gathering System, which is an ongoing quarter-by-quarter look at freight flows through the economy. It's been going a few years now, and it's actually, I think, pretty well received by the sector, quite widely used in informing decisions within the freight sector. The second piece of work we did which was published in March 2014, was the National Freight Demand Study. And for that piece of work, we commissioned Deloitte to do that piece of work. It really did two things. First of all, it looked again at the current freight flows at the time. What was the volume of freight moving around the system, domestic freight in New Zealand, what modes, where is it coming from and to? And it compared that with the previous period of time when this was done, which was in 2006. But perhaps more interestingly as well, it also then projected forward and said over the next 30 years, what's going to happen to our freight demand over the next 30 years? And it came up with the conclusion that by 2042, in 30 years, we're going to see roughly half as much, again, freight on our system than we have at this point in time. So that's a lot of extra freight to get around the system. It's actually quite considerably less than we had previously been predicting. There were a number of reasons for that. And today isn't really about that study, but it's a very, I think, an important piece of work in informing long-term planning within the freight sector. What we're here to talk about today, though, is the Future Freight Scenario Study. And that was a third piece of work that we did, again, commissioned from Deloitte, published in end of last year. And that was really a response to what was by then a very noticeable trend in the use of bigger ships coming to New Zealand's ports for the international leg of those export and import journeys. In 2012, only 3% of the containers that moved in and out of New Zealand were transported on ships that had the capacity of more than 4,000 containers. TEUs, only 3% in 2012. Just a couple of years later, that figure was around 40%. And actually, I got the graph this morning, which shows that back in January of this year, for a while in our peak period, over 50%, 52% of containers moved to and from New Zealand on those bigger ships, bigger by New Zealand contexts, ships over 4,000 TEUs. So for us, that's a very clear and marked trend, and we need to understand what's that trend, assuming it continues. What will that mean, particularly for our domestic freight networks? If we have bigger ships, it means they're going to, almost by definition, call at fewer ports. There's going to be fewer port visits. And if we see consolidation and some of the ports that we have investing to take those bigger ships, and therefore over a period of time some rationalisation going on, it's really important for us to know and to generate a debate about what that will mean for the flows of freight around the system. What will it mean for our investments in road and rail? So that was the reason we commissioned this report, and we felt it was, as in any future forecasting, one of the techniques you can use is to look at scenarios. So not what you think is going to happen, but let's look at a number of plausible scenarios into the future and see what they might tell us about the way that the freight might move around our domestic system. That's why we commissioned the report, and we went to, in fact, to the same company that we commissioned for the freight demand study, because we thought there's a lot of synergy between the two pieces of work. So I'm now delighted to invite Lisbeth Spaniard and Ros Warburton to talk to us about the study. Lisbeth's the lead freight advisor within the Deloitte's practice in Australia. I think you specialise a bit in New Zealand as well, Lisbeth. And Ros is a senior director who is also project director for this study. So thank you very much, and I'll invite Lisbeth to come and talk. Thank you.
Thanks, Nick, for the introduction. And so Ros and I have worked on the study over a couple of years. You may hear a slight twang of Australian in us as we're talking, but both of us are very much born and bred Kiwis. So we have brought quite a lot of experience to this based on our experience in the New Zealand freight market and working with a number of industries in New Zealand. So what we wanted to do was to bring that to this study as well. Our intent today is really to run through for you a little bit more about why we're asked to do the study in terms of the context and what was going on, how we went about it, and also just to take you through some of the results, sort of a summary of the key findings really and where we got to within the study. The study's available on the website. I think some of you may have read it, but it's just to sort of talk through some of the detail within that and the implications out of that. The presentation should take maybe 20 or 30 minutes. I think we've got about an hour, so we're very happy to take questions afterwards or near the end. We often find that sort of once we start getting into the results side of it, it starts to become quite interesting. So please feel free. We'd like to keep it relatively informal if possible. I'll just make sure I'm driving this correctly. So why was the study commissioned? And in order to understand that, we really need to understand the context, as Nick was saying. In particular, the evolution of the international shipping market and ports has been a significant amount of change over the last 5 to 10 years, but particularly in the last 5 years with the introduction of larger ships offshore, but the implications that that's actually having for New Zealand. There's a need to also understand the supply chain and the associated infrastructure, given that there's an interdependency across the system. An implication for a port will have a significant implication on the road and rail networks behind that port. And what you start to therefore need to look at is what is the investment coordination required. And as Nick alluded to, the Productivity Commission's report started to sort of raise those sorts of issues. So that was sort of the environment that we were looking at the study within. At the end of the day, transport is a critical input, particularly into the export sector in New Zealand, and it underpins the New Zealand economy, with exports basically representing 30% of New Zealand's GDP, but 99% of New Zealand's trade by weight is actually shipped through seaports. As we know, a very small proportion actually going through airports. So the role of ports and the role of port infrastructure and shipping was critical. And instead, there are a number of emerging trends. So if we look back, pre-GFC, there was a very large order book for new vessels and large new vessels going forward. And this resulted in a mismatch between the growth in the capacity and then a decline in demand. So you started looking at shipping lines in particular, trying to look for markets. And oversupply and demand is driving down costs at the same time as shipping lines are actually trying to reduce their costs in that structure. And that put pressure on them. It put pressure on them and then on the providers of services to them, such as ports and also their customers. At the same time, there's an excess in container port capacity in New Zealand. New Zealand is extremely well served by ports. Not a factor that necessarily needs to change, but there is capacity within the market there as well. So you start to look at how can you actually optimize a return in an asset that you've got in these various locations when shipping lines are also trying to optimize their assets. And as a result, the lines, and by association some of the customers, started to exert pressure to invest in infrastructure to facilitate the larger vessels. So that's where they're starting to come to government and saying, there's an opportunity here for a large ship to call at our port, but to do that we actually need better infrastructure to support that, and we need better road infrastructure or rail infrastructure. The challenge then becomes, if you've got a number of ports actually making those requests, where does government start to prioritise, and where do you start to get the trade-offs? The port response within that was innovation. So you started to see a lot of collaboration, resulting in some increased competitive tensions between ports, and things like Metroport evolved back in 2000. So I was involved in the very early stages of that and getting that off the ground, and that was a direct play on excess capacity within Tauranga Port, Sulphur Point, and how they could try and extract some of that volume out of Auckland. So that was a new concept into the market in New Zealand. We've seen that emulated since, with Ports of Auckland also now having Wiri, the evolution of Rolleston and Christchurch, for example. And on the other side, we started to see the customer starting to do a very similar sort of thing. So we've started with the emergence of Kotahi and the development of trying to get capacity and volume to start to exert leverage over the shipping lines. So with those sort of changes, we're starting to see parties tried to build critical mass to make themselves actually viable going forward. And it was in this context that, say, government's being asked to make investments in assets to support that growth, but it's very much a moving feast. So how did they actually go forward, and how could they inform themselves? So they recognised as government a number of potential challenges for the trade infrastructure, and these issues were exacerbated by the interconnectedness of the infrastructure and the various ownership structures in place. So you've got a road and a rail network that are owned by central government and local government in some circumstances. You've got local government ownership of ports, which can lead to tension between some of the political and commercial outcomes there as well. There are trade-offs that they're trying to address. Where port ownership has both a public and a private element, there's also an increased focus on very short-term delivery, so growth, returns, that sort of thing, which becomes a bigger challenge when you're looking at investment around assets. And we've seen this play out, starting to emerge a lot more in the Australian market, where we've had quite recent privatisation of major port assets, and the drive to achieve returns in sort of a 3 to 5 year time frame, rather than say a 10 to 15, so the payback on assets there has grown. And finally, you've got offshore ownership in most cases and decision making by international shipping lines, which are focused on their core markets. So that's traditionally the east-west trades between Europe, North America and Asia, and New Zealand, which is very much on the north-south axis. And compared to the major trades, it's a relatively small market, and with a much reduced sort of leverage within that context. So as a result, the operators in each part of the supply chain and the system are motivated to maximise their utilisation on their assets. And this is not necessarily driving in our view, and in terms of some of the results that we found, the most efficient outcome for users of the system as a whole. And it's really looking at that system as a whole rather than the system as pieces. So this interdependency, combined with a lack of coordinated planning, makes it quite difficult, in particular for government as the owner of the asset and the connecting networks, to coordinate and privatise that investment. Now this is particularly so in a state of constant change, and we can see that sort of the volumes moving, production moving, and also export markets moving on a sort of annual and even semi-annual basis at the moment. So if there's a good harvest in one part of the country and a poor one in the other, climatic changes, those sorts of things actually start to have quite immediate impacts. We've got the major ports competing for business with each other in order to grow their throughput. And the shipping lines are pressing the ports to provide those facilities that will support the use of larger vessels. So that's things like deeper channels, larger quay cranes as we get to broader beams across ships, longer berths, all that sort of thing actually drives a very significant investment right through the port industry. And again, that's not just in New Zealand, that's globally, that's starting to happen. So it's an international issue at the moment, particularly as these larger vessels are cascaded into the market. And it's also a very dynamic, competitive market and environment that moves between different parts of the system. So this starts to increase the duplication of assets and the risk around that at ports and the adjacent road and rail infrastructure. So one of the key considerations from a government point of view is they don't want to end up with stranded assets, to put an investment into one part of the network only to find that the shipping line now starts to have a trade-off between either those ports or particular customers, and moving to another port just after the investment has happened over here, having to follow it directly over there. So it was within this context and in an effort to be proactive rather than reactive, and this pressure for new investment, that the ministry came to us and wished us to help them inform themselves and to form a view of the potential requirement for future road and rail infrastructure. Now our study went out for 30 years, and so within that it is, as Nick said, scenario driven. The market will change, the players will change, the demand will change, but at the end of the day it's trying to look at what are the implications of potential different outcomes under different scenarios on what's actually required in terms of investment and where are the capacity and bottlenecks emerging. And this approach was really consistent with the findings of the Productivity Commission inquiry in 2012. So, more specifically, in commissioning the study and defining the scope, they set out to, one, understand what were different alternative port configurations. So this is driven by the need to cater for larger vessels. So we looked at a range of vessel sizes, what the potential futures of those vessel sizes could be, and what would be the potential scenarios that could play out in terms of various ports. Now we took a selection of scenarios to test, basically to test bookends and moderate ranges through that. We didn't test every combination through the mix, but it is really to inform the debate there about what could be likely implications. They also wish to understand the impact on these configurations on the export market and the exporters themselves and the broader economy as a whole. So we took samples within that of actually looking at particular markets and particular regions to understand under various scenarios who would potentially be impacted more or less under each of those, and what was going to be the impact on New Zealand Inc. rather than each of the players themselves. So trying to get that holistic view. Where possible, and it was done at a relatively high level, we wanted to identify where the infrastructure capacity constraints in the system started to emerge. So was it on the rail network? Was it on the road network? Were there particular locations that were much more constrained than others that would actually drive an issue going forward? Within that, and leading on from the freight demand study as well, feeding that information in started to help clarify the understanding of the linkages within the chain. So we didn't just look at volume going through the port, we looked at it from production through to port. So where were the linkages, what needed to be there in place in terms of, say, road, rail, but also coastal shipping, if that became an option to actually move cargo through. How did that actually release capacity in the network? And finally, they wanted to have a framework against which they could assess the impact of changes on that, say, the whole system. So the importers, the exporters, and the broader economy, rather than doing it in those small pieces. What would be the long-run effect from a net present value in economic terms from each of those issues? I said right from the start, the ministry were very clear with us in particular on what the study would do, but also what it was not there to do. So from the outset, it was there to inform the debate. We weren't there to make recommendations. We were specifically not asked to make recommendations, particularly with regard to any preferred hub or to pick a winner. It was just to provide information under a number of scenarios, and we built a very comprehensive model for the ministry to be able to test those scenarios and to change them and alter them. So it was very much, here is our view at this point in time based on these scenarios, but the ministry had the capacity and capability to take that forward and look at other options. It was also not the intention of the study or the ministry to sort out a prioritised plan for future investment. So that's either public or private. It was really to say there are going to be significant costs under any of these scenarios. Where might those costs have to be incurred and when? And from a very high level point of view, what would be the impact on that? Rather than saying this project needs to be prioritised over that project, there are already processes in place to do that. One part of study that we have been asked about, which this also did not consider, was where was the funding going to come from each of these projects. We're very much agnostic on that sort of point of view, and it was, again, really identifying what was the likely cost at a very high level, so that could feed into an economic evaluation. And finally, we didn't make any recommendations or include any detailed analysis on how to optimise the system. And that's the way that services are delivered by road, rail or coastal shipping. Now we did have KiwiRail, NZTA and a number of other parties actually involved in the study as stakeholders, and they did assist by providing information into the mix. So it wasn't done in isolation, but we weren't there to tell them how to do their job. It was really taking what we had and looking at how that actually fed through the system. So the analysis in the resulting study is designed to assess and compare the impact of a number of port scenarios. We used key agreed assumptions to produce the comparison of relative costs. So in a number of cases we used unit costs. Within that we talked to most of the ports through the study. Some were able to provide us with capital costs, some were not, and where we didn't have that sort of information, we used high-level unit costs to apply to the system, so that they haven't been through engineering rigor or anything like that. It was to provide an indicative view. And it was within that we really wanted to get the idea of relativity. So on the one hand, what are the relative costs of those infrastructure impacts? And on the other side of it, what are the benefits to each of the supply chains that actually participate in the import-export market within New Zealand? What I might do now is hand over to Roz, and she's going to take you through a little bit more on our approach and some of the findings. And then we can come back together and have a few questions and answers if you like.
Thank you. As Lisbeth's mentioned, a critical part of our approach to the study was to come up with scenarios in terms of port hubs. What we have here on the sheet is the 10 scenarios that we chose, that we measured the costs for each one of those. New Zealand currently has 10 container ports, and that was our initial status quo scenario. And our scenarios envisioned a smaller number of hub ports. So as we move across the page from 1 to 10, we had the status quo, then we had emerging trends, which are 5 key ports, being Auckland, Tauranga, Napier, Middleton and Otago. Then we had partial hub and spoke ports with 2 hub ports in each island, and also 2 hub ports in the North Island and 1 in the South Island. Through, as you move across to a full hub and spoke, and 1 hub port in each island, and finally 1 single hub port for the whole country. So quite a complicated series and set of scenarios. And I think the important thing to remember was that this was just taking examining what could happen, not what was going to happen, not recommending what was going to happen. So we really wanted to test the impact on the costs for supply chains from point of production through to international port of these scenarios. There's a couple of dynamics happening here because the study was over 30 years, and through that period we've got a significant growth in freight tonnages, and also as we had fewer ports we actually then sort of superimposed larger vessels on them. So under the status quo scenario, we had pretty much the shipping fleet that's currently serving New Zealand right through to much larger vessels over the hub ports. So it was quite complicated. Imagine. So in order to make the comparisons of the impact on supply chains in the New Zealand economy, we needed to generate cost metrics. This slide encapsulates the framework we used to develop these. Central to the methodology was the creation of a freight movement model, which measured the movement of containers between domestic origin and destination, New Zealand ports and international ports. These movements were based on the work undertaken by our team on the freight demand study, which identified the interregional and interport movement of freight. Based on these movements of containers, we were able to identify for each scenario traffic flows and bottlenecks in the system, both road, rail and ports. We were then able to identify the capital cost of alleviating the bottlenecks and the cost of transporting the containers by mode. So we used road, rail, coastal shipping and international shipping. We then used the metrics to calculate the transport costs and implications associated with each supply chain and the economic implications of the associated changes and costs. Critical to our process was to have as much evidence as we could to base our findings, and this required a substantial amount of source data to be gathered. We were obviously able to use the FIGS data, which was a great source of information, the National Freight Demand Study, and we also consulted with all of the ports, the shipping lines and infrastructure owners such as KiwiRail and NZTA. The consultation element in particular was used to help establish the baseline scenario, to identify current and future views on developments within each component of the system and to gauge the likely response to the market by the market to change. For example, it was used to test the thinking around the introduction of larger vessels, when they might arrive and which services they would be introduced. So in order to allow for the comparison, we generated 4 key metrics. The capital costs, operating costs, we did an economic cost-benefit ratio and then looked at the overall economic impact on the economy as a whole. So the capital cost estimates were those costs that would be incurred by asset owners, ports, rail and road, to alleviate bottlenecks in the network, resulting from forcing freight into these hub ports. Due to the whole of system nature of the work and the scope of the study, it has not been possible to undertake detailed analysis of each individual port or piece of the road and rail networks. And that's quite critical really, because each port will be doing what it thinks best for its own business and its own business model, whereas we were just trying to take a very holistic view of turning bits of the network on and off. And neither has there been any assessment as to the physical, technical or financial ability of asset owners to undertake capacity upgrades. So when we get into the results, you'll see with one hub port in the North Island, we're talking about considerable capital investment, but whether that's actually realistic, given, whether you can actually realistically develop a port in those circumstances, we didn't even address that. We just took it that you could. The operating costs are the costs that are incurred to transport the containers to hub ports and the costs of the international shipping leg of the journey. So these costs were generated by modelling reference vessels, trains and trucks on a bottom-up basis. As an illustration, blue water shipping costs were calculated for a number of vessel types ranging in size from 2,500 TEU to 8,000 TEU on $1 per TEU per nautical mile. As port operating costs are unique to each port, port tariffs were used as a proxy to estimate port operating costs, and economies of scale were reflected in the shipping and port costs. For example, the cost per TEU of a large hub port were estimated around $67 per TEU, whereas a small port was about $83 per TEU. So we'll just now move on to the findings. This really reflects Nick's comments earlier about the larger number of larger vessels coming to New Zealand waters. So the total TEU shipping capacity, or how many TEU slots have been provided into and out of New Zealand per annum, and the medium size of container ships visiting New Zealand. So the darker blue is the medium ship TEU capacity, which is trending up, and the other one is the total ship TEU capacity. Whilst there has been quite strong growth, it has actually flattened out in recent times, which is quite interesting. And the graph indicates that the trend to larger ships is continuing. Over the past 7 years, the average container ship visiting New Zealand has increased in size from 1,800 TEU to 2,800 TEU capacity. And furthermore, in the last 18 months, even larger vessels over 5,000 TEU capacity have been visiting New Zealand ports. As the average size of vessel has increased, there's been a corresponding decrease in the number of vessels calling in New Zealand. In 2008, there was an average of 254 ship visits per quarter. Over the past 12 months, this has been reduced to 215. So that means the frequency of services is decreasing as the size of vessels increases. And that has implications for exporters, particularly for exporters of perishable goods where they need speedy delivery to market. This trend is not unique to New Zealand, as the lines are seeking to expand the use of larger vessels to realise the lower operating costs generated by the larger vessels around the world. As these larger vessels are actually concentrating on fewer ports, it requires significant upgrades to ports and related infrastructure. And that trend is happening both here and all around the world, where the shipping lines are introducing much larger vessels, then putting the pressure back on the ports to actually invest to cater for them. But what is not clear is whether the savings from the larger vessels will actually flow through to the customers. So, in terms of the capital costs, this slide shows the actual capital costs we estimated would need to be spent for each of the scenarios over a 30-year period. As you move across the graph from left to right, you see the impact that fewer hub ports will have on infrastructure investment. So, as I said before, scenario 1 represents the status quo, so lots and lots of capacity, not much need for investment in new infrastructure at ports. I think also you need to note that scenario 1 does not envisage much larger vessels, so there isn't a lot of demand to actually invest for the bigger ships. Scenario 10 represents a single hub port for all of New Zealand, and under that scenario we had the other ports supporting feeder services to the hub because the road and rail network just couldn't cope with the additional volume of freight moving on it. So whilst this would be a one hub port, international port, all the other ports would still have to exist to provide coastal shipping services to feed it. And as I said before, as you go across the graph, the introduction of larger vessels is accelerated. Scenario 1, the largest vessels we had was 4,500 TEU, but under the hub scenario we assumed 8,000 TEU vessels, so that's a significant increase in size. So just to put this in perspective, based on the demand forecast, by 2047 the single hub port would be handling 5 million TEU per annum. At present, New Zealand's largest ports, Auckland and Tauranga, handle approximately 800,000 TEUs per annum. Port of Melbourne, for example, is 2 million TEU, and hub ports in Asia are upward of 9 to 10 million TEU. So we'd be talking about a significant port if we just have one hub port, over 5 times the size of Auckland and Tauranga. So what investment will be required? We'll need deeper channels, longer berths and larger quay cranes. And road and rail networks will require upgrades and improvements, particularly to connectors to ports. It was actually very interesting to note during the analysis that the road is more capacity constrained than rail, and this is reflected in the capital requirements for road in the graph, which is the dark blue columns. So rail has lots of capacity. This graph represents the operating costs and the capital costs, and as you can see, the cost of the operating costs is far in excess of the capital costs that would be required. So, scenario 1, the numbers look quite alarming, but the change is significant, from 24.27 million to 19.5 in scenario 1. But what really surprised us, which is kind of obvious really if you think about it, was that the operating costs were significantly higher than the capital investment required. So, and where we say operating costs, that's actually the transport cost of moving containers from point of origin to the port, through the port and on the international shipping leg. So it's not really that surprising as you have larger domestic transport requirements, the costs are going to go up. The other thing in here is that it also includes the benefit of larger vessels, so we took that into consideration. So we found the potential benefits that New Zealand gains from larger vessels and port hubbing are outweighed by increased port costs, domestic freight costs and capital costs infrastructure. So what we did was we actually took, for the study, we assumed 100% of the benefits of the larger vessels would be passed back to the cargo owners, which in reality doesn't seem to probably very likely. I think in reality shipping lines will only pass on the savings if they are forced to through competitive market tension, not because their costs are lower. And that's particularly given too that the shipping lines are under increasing financial stress and have been so since the GFC. So any benefits they get, they're very unlikely to pass them back to their customers unless they have to. There are considerable operating cost benefits associated with larger vessels. We found that lines can achieve just over a 10% cost reduction per slot for each step in a ship size. So, for example, a 4,300 TEU vessel slot may cost approximately $600 to operate. This drops to $470 for an 8,500 TEU vessel and $420 for an 11,000 TEU vessel. So it's a considerable benefit there for the shipping lines. However, a key part of that is that the vessels have to be very highly utilised or they just don't get the benefits. And these findings, I think, were reflected in the International Transport Forum's report, which was released a couple of months ago, which found very similar findings that the vessels need to be highly utilised before you get the benefits. Part of being highly utilised is you actually have to have the number of containers to pick up each time you service a market. So if you're coming to New Zealand with a large vessel but you can't actually fill it, there's no benefit. So there's a whole lot of dynamics working there. Another key finding, unsurprisingly, was if you are adjacent to a hub port, your costs will be lower. So that's what this graph is reflecting. So as you would expect, the closer you are to the hub port, the better the benefits. And we found we didn't have Wellington as a hub port in any of our scenarios. So cargo owners in Wellington and Taranaki are likely to be significantly worse off under port consolidation scenarios. Cargo owners in Auckland, Canterbury, Waikato and Bay of Plenty are all better off, with savings greater than 15% under some of the port hubbing scenarios. Other factors that could have an impact on supply chains are Only cargo owners moving cargo on trade routes served by larger vessels, such as the Asian trades, will realise cost savings under the port hubbing scenarios. So not all of the trades are going to end up with the larger vessels. Cargo owners who currently rely on high frequency, high speed or high reliability of service under the status quo may be negatively impacted under port hubbing scenarios with larger vessels. And as we've already seen, a move to larger vessels is resulting in fewer shipping services for New Zealand on each trade route and reduced frequency. So that trend is already emerging. This is a bit alarming, this graph. This represents the economic benefit of the port hubbing. So this was a benefit cost ratio analysis that we did, which basically says if you invest this capital, what are the benefits you're going to get? And what we found was that you invest capital and you actually don't get any benefits. In fact, you get more costs. So we found that a rational investor would not be making these investments, basically. So the projected BCR for all the scenarios is less than 1 and almost all less than 0, which means for every dollar spent in capital, it will cost the supply chain an additional amount. So where the BCR is less than 1, there may be some economic benefit, but this does not offset the additional capital costs. So the economic modelling suggests a negative return for the economy on the investment that will be required to accommodate larger vessels at fewer ports. I just want to reiterate that this analysis is for the entire system. There will in fact be winners and losers under each scenario within regions and sectors, and individual asset owners and operators will make decisions based on their circumstances and business strategies. So that's sort of the end of the findings. Like, does anyone have any questions or?
Hi, my name is Charles Finney. I'm representing the Port CEO Group and the Shippers Council, the people who own the freight that go on the ships. Can I just ask, are there journalists present?
Yes.
Good, okay, that's fine. Both of those groups do have serious concerns about this study.
Mm-hmm.
We're concerned that it is dealing with containers only, and over 50% of New Zealand's export freight is non-containerised. So in terms of decisions about road, rail, coastal shipping investment, there's a big issue there. And also we were concerned about some parties not being consulted. We know you did consult the ports, but I think you'll be prepared to admit that not all ports were cooperating fully in that consultation. So please, to everyone in this room, we believe you need to treat this study with great caution. Thank you.
I was intrigued by your very early comment that the freight costs in New Zealand are significantly greater than those in Australia, whereas after the port reforms in 1980s, late 80s, it was the reverse. Can you account for that difference?
It comes back to a number of components, I think, in terms of both the land side cost component and the marine side as well. So it's that trade-off between the volume. New Zealand can still achieve some very competitive freight transport costs where there is a consolidation of cargo and there's a high volume between an origin and destination. But in terms of some of the cost, there is still a very high landside component in New Zealand relative to elements of Australia within that. So it depends on a market-by-market basis and the particular commodities that are being moved.
The comment you made was it's an overall position, and do you think that statement fairly reflects the position?
What would you say?
Well, I think that the couple of dynamics there in terms of transport costs in Australia. You have larger vehicles, road
Larger
vehicles.
volume.
Yeah, larger volume.
No, a higher mass limit.
Yeah,
On a lot
bigger
of
trucks. The other thing, that the container port system there is quite different here in that the container ports service a distinct hinterland. So going down the east coast, you just collect containers from your hinterland, whereas here there's a lot more crossover as containers move up and down the up and down the country. So that adds cost as well.
There'd be very few. In New Zealand, you still have containers that might move 1,000 kilometres, so something moving out of Canterbury or Dunedin potentially for a hub out of Auckland. In Australia, the longest distance would probably be 350, 400 kilometres maximum before it actually goes through a port. So there's very few that would move over that sort of distance.
Okay, thank you.
Sorry, it's not a question. It's just something I should respond to Charles's comment on the point about this is a study that only looks at containers. Absolutely, bulk shipping was not included in this. Bulk will be much less likely to hub because it tends to be lower value for weight, so it will tend to go to the local port rather than being shipped around the country. Transported around the country to a hub. And I think the important point behind that is this is not a study about will port A be one that survives or withers on the vine, because a number of ports don't have containers at all, and you can't say just because a scenario excludes one port that means that port won't survive as a container port. It also might have bulk as well. So don't use it in that context. The comment around consultation, I mean there's some truth in the matter, and we have already apologised to one or two key players who we think should have been included in the data gathering. What I'd say about that is this report followed on from the National Freight Demand Study where there was very extensive consultation. We used the consultants used the same database for working out if a local port was not to be there, how the freight from that region would get to which other port and how it would get there. It was all based on the information, the insights that the National Freight Demand Study gave us. So again, it's not perfect, and I think what we would say is engage with it, use it, test it. It's about generating debate, not about having the answer.
Thanks, Nick.
You stated that the reason for the greater productivity in Australia with the heavier truckloads that they have there. Are you sure about that? Because my understanding is that the axle loadings in Australia, other than those very few arterial routes where they have the road trains, are actually less than ours. I think the key is that they pay only a third of the road taxes that we pay in New Zealand, which is a real big issue. Essentially, their road freight is subsidised.
That is true. There are actually more than the arterial routes that do have high mass limits on them, though, because there are a number of areas around the ports that also have high mass limits and access to that. But yes, the underlying cost structure, it starts to get reasonably similar. It's still around $2 a kilometre. Thereabouts $2.20 for most of the vehicles. So which is not that different to the New Zealand market, but often it's actually the distance that they're hauling and the average speed and that sort of thing.
Hi, Catherine Baird from Export New Zealand. If this is true, then it is quite concerning for exporters because it indicates it's going to get more expensive and harder to get goods away, both at the right price and in a timely manner. But I guess my bigger question is, if this is an international trend and the world's going to bigger ships, what can we do? Are we a bit stuck with this? Because if the global market's changing, what can New Zealand do to have an impact on that? So what are some positive suggestions?
You're seeing that in what Kotahi's doing. And with inland ports, consolidation of freight at inland ports, giving more option for exporters to go to different ports, I think that's really important. And I think also my view is that there'll be more and more there is already a lot of hubbing through Asia from this part of the world. That'll just continue to expand and grow. So I think it's really... And that's where it gets complicated, because this is a scenario-based analysis of everything being equal. But individual operators, exporters, port companies will do what's best for their own supply chain and their own customers. So I think through what's happening here is that people are trying to build a critical mass to give more leverage in terms of actually dictating or having better control over the services that they're buying rather than just being a service taker. And I think that's really important. I think there's also some talk of more hubbing through the Australian ports, but in effect they're in the same place as well. So they're going to have to invest for larger vessels.
I'd add, this is not a New Zealand only issue or a New Zealand exporter only issue. The International Transport Forum study raises this as an international issue. So large ships, port sizes, apart from the major hubbing ports, where they have invested in 14, 15 metre drafts very early on, there are a huge number of ports globally that are actually in this position. And there's a lot of pushback within their study raising the issues that a lot of the cost of port expansion is potentially being handed back to other parties, to the public, through government or through other infrastructure assets. So we're raising it as an issue potentially in a New Zealand context, but it's also potentially an issue at the receiving port for those sort of large vessels. So it's not a New Zealand's going to sort of bear the brunt of all of it. Those issues need to be addressed elsewhere as well. So there will be pushback from other parties as well. I think
because the port sector is quite interesting, because a lot of ports are owned by governments, so it actually falls on the taxpayer to fund this. So which adds an extra dynamic, particularly in Asia and places like that, where they're actually calling on the local governments to fund deeper channels, bigger, key cranes or whatever. So it becomes
I think
quite
they're doing a
politicised.
couple of case studies at the moment, I think, on Hamburg and Jakarta, in terms of what the implications are for that sort of scale of port, and what the costs that bringing larger ships in would actually bring to bear on them, and how that would flow through. So it's going to be interesting to see the findings of those case studies as well.
George Hoover and Vision. Look, this is a question of ignorance, but I'm hearing you suggest that a scenario that's not covered in your study would be a Melbourne hub.
That's right.
Okay.
It would be more like scenario one.
That was my question. So the gut feeling is, if we forgot about having a hub and let the Australian taxpayer deal with the costs of the hub, where would that blue line look like for scenario 11?
Scenario 11 would probably be a lot closer to
Scenario 2.
Well, scenario 2, almost scenario 1, the base case. There would be a slight impact on blue water costs and that sort of thing.
It'd be higher.
Yeah, it would be higher in terms of that dogleg that you're doing, but in terms of avoiding the capex, that avoidance would be significant, and the change in land-based transport costs here, domestic costs would not change.
There's always been opposition to hubbing in Australia because of the additional time taken for time-sensitive exports, and I'm not sure that too many people would welcome that as a solution. But my question is that the increasing size of ships is to some extent an assumption of cascade from longer hauls, right? So we're forced to take them because that's all there is available. Now, my understanding is that the major lines are actually building new build 4,000 TEU ships specifically for feeder. So is it a real prospect that we will be forced to have larger ships or not?
I think that's a very good question. I think that a lot has to play out yet before we'll know the answer to that. Because the other thing with the larger vessels is you have to have them very well utilised to get the benefits. And in fact, some of the biggest benefits they're getting from new vessel builds is the ship's ability to steam slower. So in fact, you're getting more benefit from the vessel going slower and the reduction in fuel consumption than what you are in actually getting the benefit from having more containers on a vessel.
And I think within that, they're starting to find that they made significant savings and cost savings by moving to larger vessels initially, building that utilisation. But the engine technology and that sort of capability is now being able to be brought back into some of the smaller vessels. So the cost efficiency, they're sort of hitting that marginal benefit level now out of size, so they're starting to apply it to the operating of the vessels. So when they're starting to look at a more efficient, for want of a better word, hybrid type power systems, then that's actually enabling them to pull back some of the size of those vessels. At the end of the day, they need to utilise every slot possible. And they start to, as soon as they sort of drop the utilisation of the vessels by 25%, the cost per unit goes up by about 30%. So unless you're actually running at 80-90% utilisation, you have a more costly unit.
Sorry, just to help answer the question. In today's charter market, the price of a 6,500 TEU ship is about $500 a day, different from a 4,500 TEU ship, and another $500 a day to a 2,700 TEU ship. So your economics is completely different. You are seeing cascading effects. They are having the price of shipping is not different in those sizes of ships, but the economics per slot are different, of course.
And I think a lot of it's going to depend on how the ports actually start to exert pressure back on shipping lines. So at the moment, ports have actually been driving in trying to attract larger vessels because it attracts additional volume through their port. So the incentives have been there to generate those bigger exchanges. But once they have to start to pay the additional capital and the investment in the infrastructure, they need to look at what's the trade-off decisions they're making. They're actually potentially building a rod for their own back. So if they start to pass on the costs that they're incurring for that investment in bigger cranes and those sorts of things to the shipping lines, there may be a slightly different sort of motivation within the mix as well.
Just a question about the Northport that's been in the media recently. I noticed it wasn't in your scenarios, or Timaru in Prime Port with the announcement with the Tauranga alliance. So just if you could comment on just the dynamism of the port sector and how it sort of was advancing further than your study or faster than your study. So
It was, yeah.
just if you could comment on Northport, the commentary in the media recently about that being a potential alternative to Auckland, and also the rise of potentially of Timaru as a feeder for Tauranga.
We did discount Northport as a scenario quite early on because of the associated land infrastructure, and also we were told that there were some major navigation issues there in terms of getting larger vessels in and out, and I'm getting some shaking heads here from our port colleagues, but I understand we didn't actually consider Northport. And Timaru basically got that came into the coastal shipping scenario. So what's actually happening with Timaru and Tauranga is really reflected in our scenarios in terms of using coastal shipping to provide feeder services.
But the influence of that is worse transit times, poorer service to the exporter and to the importer, and an additional cost. From transporting by coastally from Timaru to Tauranga.
That's right.
So the economics don't necessarily work. They're just creating cost and additional time that cannot be paid for in the supply chain.
We agree completely.
Direct calls is always the cheapest option.
Yes, that's exactly right.
And I think that's what our
which
study
is what the study ended up showing, which is bleedingly obvious, really.
The status quo is for any particular exporter, they're going to have to make up their own mind about what is the most effective and cost-effective path to market. And generally that will be through the port in closest proximity, as long as it is served to the market that they're going to. And that's the big question sort of sitting on the horizon, is what trades are going to access which ports, and how are they going to access those. So it's very much a set of questions going forward, not necessarily a set of answers.
Okay, look, we'll wrap up there. Thank you very much. I'd really like to thank Lisbeth and Roz. Thank you for presenting your study. Thank you, Nick, for coming to provide some context. The Business New Zealand Energy Council are also doing some scenarios out to 2050, and I have to say the key challenge with scenarios is yes, they deliver insights, but it's actually knowing how to use them, and I think that's been highlighted by some of the conversation here today. So thank you very much, and I'd like
Thanks, John.
you all to thank you.